Good morning. So today I thought we'd do something a little different from our weekly updates and bring in a guest, which is why I've invited Hedley Widdup from Lion Selection Group. Now, Hedley is an experienced geologist and fund manager, and I caught up with Hedley about 2 weeks ago after he presented at the Resource Rising Stars conference on the Gold Coast. So he kindly offered to join us today. So Hedley, welcome. It's great to have you on.
Thank you very much, James. And it was lovely to meet you. For the guests that are listening in, we had breakfast at the South Melbourne Market, which is a glorious way to meet anyone, and it's easy to spend a couple of hours talking about markets.
Absolutely. Yeah. So Hedley, just to kick things off today, did you want to tell us a little bit about Lion Selection Group and the types of stocks you typically focus on? So whether your fund has a sort of commodity focus or just targets certain phases of development.
Yeah, sure. So Lion's been around now since 1997, so it's going on 26 years old. It was listed as a company to take a venture capital style approach to helping junior companies develop projects. We've previously had a worldwide mandate. I think it's fair to say we're focused primarily on Australia at the moment. So it's a company lists, trades on the Australian Stock Exchange. The code is LSX, and that's so anyone who wants to find out a bit more about it, just hit LSX and check that out. But the headlines of it are, we sold out of a couple of large gold projects that were in Indonesia. It was a very difficult process, but we managed to take a meaningful amount of cash out over the last, say, 2 or 3 years. We saw a fairly heady market coming, so we took advantage of the opportunities to sell those. We took about 95 million bucks out of those transactions. We've returned about 15 or a bit more by way of dividends to our shareholders. And there's a nice big nest egg there, which is earning 4% plus in interest, which is outperforming the market at the moment, and is earmarked for purchasing companies in the junior space. So that purchasing power is multiplying at the moment. And what we look at is any company which has a mineral resource project which can be developed from a grassroots stage by a junior. So we try to avoid things that have big infrastructure spends, difficult marketing propositions of their commodity. And that drags us, if you like, towards, I suppose, a top level of commodity focus, which is gold, copper, nickel. They're all sort of from the old economy, if you like, and definitely intersect the new in a couple of cases. And lithium, which is added to that list more recently, is something which we've seen a lot of junior companies successfully develop projects and then become very successful after that. So we're happy to look at a lot of other things, but those are probably the favourites. And if we were going to spend 10 to 15 million bucks in one place, I'd say it would be focused on one of those commodities. If it's something in a separate commodity, it might be a bit less than that. So quite a broad mandate. Focused on, I suppose, managing a portfolio of things in the junior space, which a lot of people struggle to do themselves.
Yeah. And Hedley, how long's the fund been running for?
So 26 years, I think, in July. It was listed in late July 1997, which was just before the market started to tank, actually, in 1997. So it raised $100 million as the nest egg to start with. And in that period of time, it's returned $3.40 or so a share in dividends. So when there's been windfalls, that's been the model, is to return windfalls to shareholders.
Yeah, so it's experienced plenty of booms and busts and everything in between in the industry. Yep.
We're very, very focused on the cyclical aspect of the industry, and we think that you can pick stocks all you like. Your investing experience will be influenced so strongly by the cycle. You need to get that part right first.
Yeah, absolutely. So Hedley, just moving on. So we spoke about the Resource Rising Stars conference that you presented to last month. I'm wondering if you can give our listeners just an overview of your presentation, just sort of some of the emerging themes you're seeing in the industry at the moment.
Yep. So the Resource Rising Stars is a conference which gets held every year on the Gold Coast, and it attracts quite an interesting audience because they're quite a sticky audience. And I suppose I only mention that on the basis that instead of going there and trying to, give everybody a flash in the pan, it's kind of a moving feast. So each year I update my views on the cycle and the mining sector with them. So the theme of this year was very much that we've seen inflation start to impinge global markets. I mean, inflation appeared long before global markets reacted to it. And when global markets did start to react from sort of late 21, early 22 onwards, they've weakened. The hardest hit sector has been tech. So you look at the US market indices and they've come down quite considerably, although I suppose you'd say that in 2023 they've flattened rather than continuing to fall. They're just marking time, wondering which direction next. The resource space has really propped up the Australian market. So if you look at something like the All Ordinaries Index or the ASX 100 Index, the Australian market has been reasonably resilient. If you split that out though, and you have a look at the ASX 100 Resources Index versus the rest of the market, which is the ASX 100 Industrials Index, the two separated in probably April-ish 2022. So the All Industrials in Australia has fallen. They're down by about 15% or so. The resources, you know, depending when you pick your start and end point, let's say it's flat, it could be up a little bit. But if you delve beneath that in the smaller and smaller stocks, and this trend is true across the market as well, if you're a micro cap, liquidity has come away, and probably there's been a flight to safety in some of the larger stocks. So across the ASX Small Resources Index, that's down about, I think it's 22 odd % since April 2022. And beneath that, on ASX, the largest number of companies in a sector is in the mineral resources space. There's about 660 odd companies which sit outside of an index. They're classified as minerals companies. Most of them are explorers. Since April 22, their collective performance has been almost 50% down. 87% of those companies have had a negative share price performance in that time. So I was standing in front of the crowd to say, look, you know, we've seen the mining sector boom since 2016. And here we're seeing liquidity fall away, and that's damaging share prices. It's most evident at the bottom of the capitalization spectrum there. Now, the reason that happens is the market is uncertain. It flies away from risk, and explorers are one of the most risky propositions you can take on as an investor. So that part of the logic is fairly clear. The interesting thing about it is that since that same rough period, late 21, early 22, we've seen commodities soften as well. There's a lot of commentary in the press about how positive the fundamentals are for commodities, and I would agree with that on a long-term perspective. You know, the whole premise of electrification, undersupply against excess demand in most commodities, that will play out. But in a period where the outlook for the market and the outlook for the global economy is incredibly uncertain, inflation doesn't seem to be going away. That tends to indicate that interest rates might have to creep up a bit further. And that interplay with markets is very damaging. So as long as that goes on, I suspect we're going to see weakness in equities, which will be worse for the ones at the junior end, which is where we invest, which is why we watch it so closely. But I don't see commodities providing a strong lead. So that was the other part of the talk, which is that we've seen commodities soften, and there's a point in every cycle where you get to the top and you have to question, is the fundamental trumping the trend here, or is it the other way around? There's a loud cry for fundamentals at the moment, but that was also common in 2007 and 8. Commodities were all still going to the moon, had wonderful fundamentals, yet the global financial crisis wrecked that, and we had a short recovery from 09 through to 11. And again, commodity fundamentals were excellent, yet there was a 5-year period of weakening that followed that. So, you know, you've got to be fairly circumspect about how you play with fundamentals and how you buy stocks off the back of it.
Yeah, absolutely. So with this weakness, would you see any opportunity to sort of jump in, even though we've still got these rising interest rates? I mean, the US debt ceiling, that's pretty much out the way now. Slower growth in China. All these sort of weak signs, would you see some potential commodities to focus on over the next sort of 12 months?
Yeah, look, I think it's definitely producing opportunities, and you have to be careful with how you interpret that, because if I say that to an audience of people, they go, well, hang on a minute, financial advice and all the rest of it. I'm not encouraging anyone to jump in. So, you know, it always comes down to their own personal circumstances, but we see this market as producing opportunities, but it's also important to note that that's a trend in progress. There's all sorts of things people say, like, don't try to catch a falling knife. It's probably not so severe at the moment. This is an edging down, and it could get worse. If there's an event which affects the whole market, then, you know, the junior side of resources will definitely suffer a lot. So if something's gone from 20 cents to 10 cents, I can think of a load of examples that have done that in a little over 12 months. that produces a great opportunity, because there was a lot of those I was looking at 20 cents and saying, I don't want to buy it for 20 cents. That's quite expensive. 10 cents starts to take account for quite a few of the risks which exist in a lot of those stocks. So I'm a lot more relaxed at 10 cents, but I'm going to feel a lot better about it at 5 cents. So, and I can see 5 cents as being in the future of quite a few of the things which are on my watch list at the moment. So yeah, it's creating opportunities. Now the risk, I guess, for a lot of people who might be sitting there going, well, I'm happy with paying 10 cents for the thing, and I might not have to wait to 5 because it might turn around at any moment. That's true. And you've got to be really, really careful when you try to pick what you think might be the bottom of the market, because first of all, it's easy to go far too early. And it's also very easy to miss the bottom on the basis that, well, we've just had a horrible event, and that makes your entire outlook pessimistic. So you've got to second guess yourself on both fronts there. But the risk is, if you pick something at 10 cents now and you really believe in it, it's got a great story. And I think there are quite a few things around that do. The issue that you might have as an individual investor is that if that company needs to raise money at a cheaper price, particularly to survive through the bottom of a market, which is going to be the tough thing for a junior exploring, even developing potential mining company, the dilution that you will cop if you can't follow your money is going to be such that it will wipe out your performance. So you need to be able to follow your money, which means you need to be liquid at the moment. Now, where does that draw me in terms of commodity interest? Well, I suppose at the moment, with inflation in the market, gold has a fundamental which a lot of people can't take their eyes off. These discussions about debt ceilings and financial crises and everything else, they provoke discussions about what's an appropriate reserve currency and all kinds of highbrow things. They all favour gold. Gold trades very strongly in an environment when inflation reduces the real rate of interest to negative or low levels. And at the moment, that's where we are. So, historically, the last 60 or so years, gold has traded very positively in an environment like this. So I expect that to be the case for gold, and, it's playing out. So that's a great place to start. It means a little bit of money can be raised, but there's also value to be produced in the underlying projects. Longer term, I think now is a great time to be collecting a grab bag of interesting things in things like copper and nickel. There'll always be a market for it. Lithium a little bit more cautiously. Not so much heat has come out of that price, and that's a small sensitive market. So lithium can move with quite a bit of volatility, and it's difficult to read things like stocks and what the buyers are doing. Buyers of new commodities like that need to build production very quickly often would like to see oversupply engineered. So, they'll be very quick to offer MOUs and offtakes and even investment if it means that it brings down their operating price for the next 20 years. So I'm a little bit cautious about lithium at the moment, but happy to be, I suppose you'd say, tagging investment situations with, if it might be 10 that we want to put in over the course of a development or something, 0.5 to 1 now is going to get us set, and we know we're liquid enough to back those things. So they're the 4 things that I'm watching carefully. There'll be others by exception, but when you go through a period of time like this where there is a lot of risk around, getting into the hotter themes, and there's a few around. We've seen uranium. I think the price outlook for that is great, but uranium is sensitive to disasters, so be careful of that one. Rare earths, heaps of interest around, especially for exploration of those. The last rare earth project that I can think of that's been developed in Australia, was a long time ago. It's incredibly high grade. So, will rare earths still be hot in 3 years when some of these things are getting to the end of their studies? I don't know the answer. So I'm prepared to wait on those.
Yeah, and back to the copper story. So you said there's potentially some opportunity there, but I mean, there's still a lot of sort of weakness on the horizon, but that longer term sort of demand from renewables and perhaps some of the supply as well from places like South America, declining output. And we spoke last month that when we had coffee, that there's just not a lot of opportunities in Australia for certain copper producers or developers, especially because Oz Minerals has been taken off the table. Have you sort of looked overseas for some development opportunities, maybe in Canada or some TSX listed stocks in South America?
Yeah, look, we've cast our eye over those. The challenge, I suppose, that poses for us is that And we've retreated to a position of wanting to favour safer jurisdictions, and that's informed by a period of about 12 years of investing in Indonesia in gold. So it wasn't a commodity related concern. It was far more just trying to extract a return and then cash from a jurisdiction, which is quite difficult. Now, that's not to say that South America is anything like Indonesia, but it has really opened our eyes to some of the difficulties of operating in a place which is offshore, when there's an interruption like COVID, so you can't get face to face, and where the rule of law can be fluid at best and works far better for locals than it does for foreigners. So we look at projects in places like South America and we think, well, if we'd like to go there, we need to go there for 4 or 5 things, not just one. And we need to be certain that the projects are materially better than what we can see in our home jurisdiction. And I think to that end, we'd be far happier to manage jurisdictional risk by avoiding places that we don't feel like we understand, by missing out on a commodity and achieving our diversity across a different group of commodities. But having said all of that, the things which we've been looking at in Australia on the copper front, early stage, they're not mining, they don't have studies in place, but they're drilling and I think are encouraging enough for me to be able to say, well, you know, my watch list has got 5 things on at the moment, which have got CU scribbled next to them. And they're kind of amongst my favourites at the moment. So, you know, they're progressing better than the golds that I'm watching as well. So, you know, as much as there is lesser opportunity and we've seen the top end cleared out, I mean, I think that might result in some money being released for copper directed activities and exploration. And it might even free up some projects as well at the smaller scale. You know, so there's a backfilling at the top end of the market to do that might be quite productive in terms of bringing some copper projects through.
Yep, absolutely. And I think, yeah, just back to the jurisdictional risk, I think, so Chile recently announced it was looking to nationalise its lithium sector, so that certainly has the potential to spill over into the copper sector as well.
Yeah, I agree. And I mean, resource nationalism always rears its head when commodity prices have gone high, which means towards the top of a boom. And then if commodity prices weaken again, nationalisation looks a lot harder because all of a sudden the margins disappear and it's easier just to take tax revenues off them before they've made any profit. So I tend to think that could soften, but the intent just always lingers in a place like that.
Yeah, absolutely. And you've got Peru as well with the riots, and you've got the DRC, which is another key copper producing area, but that's got huge sort of nationalisation risk as well.
Yeah, yeah.
So Hedley, just moving on, I just want to get your view on sort of M&A, mergers and acquisitions activity. So lithium, it's the new kid on the block in terms of commodities. We've recently seen some M&A activity on the back of weaker prices in 2023. Just sort of seems to me that the M&A activity across the board is active, but it's not overheated. And that's probably a good sign given the frenzied activity that marked sort of the peak of the last boom around 2011, 2012.
Yep.
So I think we've got that sort of a healthy appetite for M&A activity, but it's not this sort of overzealous activity, which is perhaps sort of the sweet spot of where we should be in looking at timing or getting into these resource stocks.
Well, M&A is a really useful cyclical indicator, and I think you've got to apply a little bit of an adjustment to it, and think about behaviour in the last decade or so before you start using things like overheated valuations as an indicator of where we are in the market. I think the size of the M&A is the most diagnostic part. So we're seeing big M&A. We see that when the cycle is getting close to or is sitting at the top. In 2007, I think we saw one of the biggest, most overpriced acquisitions ever, and that was Rio Tinto taking Alcan, and they paid a huge amount for it and got very, very little out of it. They bought a coal situation in Mozambique for $4.5 billion, I think it was, and later sold it for 50 million just to get it off their books. So, you know, there was some very overheated deals taking place then. Mining was the hottest place in the world to be in equity markets in 2005, 6, 7, and then again in 10 and 11. So that cycle, I would say, was partly defined by the hottest money in the market chasing that as the hottest theme. Now, if you go back to the equity market hot periods before that, it was the dot-com bust and boom and bubble bursting. So if you just boil it down very, very basically to sentiment of what the biggest money in the world is chasing, there was a point there where big money got really involved with some early stage tech things, got their fingers badly burnt. I mean, they torched, if not most, all of their money that was in some of the tech bets which they were making. And these are, big institutions are trusted to manage large amounts of money for large groups of people. And you just can't be investing in things that lose money when you're in that situation. You're better off just tracking an index, and that's what most of them now do. So then when the mining boom came around, and this was driven by the emergence of China as a real market mover in commodity markets by purchasing so much to fuel their economic growth, the hot money said, well, we're done with tech. Let's get into mining. This is fantastic. And bear in mind, there's always money spread across both of them, but the weightings become huge. So on the Australian market, the average long-term market weight for miners is about 15 or 16%. I think in the 2007-8 peaks, it was hitting 30. So it was an enormous pushing of money into a space well above the levels which it would normally be, and it was overpricing those things. And that encouraged behaviours where mining companies could say, well, our paper is worth so much. Why would we spend cash on anything? Or, we can issue paper to raise cash so easily. Why don't we just go and buy things? And so, that M&A, I think, was driven with that mood. 2011, the penny dropped and institutional investors started saying to the mining companies, hey, mate, your return on invested capital has been absolutely woeful. So why on earth should we not only give you money, but continue to hold the shares that we do? And I think the moment that probably brought this around was a very, very high-priced IPO of a company called Glencore. It was the largest mining IPO ever. So a lot of big money managers had to sell stocks in order to free up the money to buy their portion of the Glencore IPO so that they could be in, they wait across the market. They've got to be in the big companies. So they were almost forcing themselves into it. When you sell something to buy something else, it sort of forces a little bit of a rationalization of value. And that's the point where buyer's remorse could kick in. So I see that as being fairly, a catalyst for what happened in the market after that. But it led to a 5-year downturn, 2011 through to very early 2016. The market was just focused on what poor custodians of money miners are. So the boom that followed, coming out of the bust and going into the period where commodities start to rise, miners start to get a little bit of favour again, was completely flavoured by, we're happy to back you, but don't screw up your acquisitions and don't screw up your return on capital. So just be very, very careful. And you can see in capital expenditure trends, increases in things like exploration has taken place in a normal cyclical fashion. They go from the base in the bust to the peak in the boom. Capital expenditure has remained very, very flat. So there's been very, very few big projects invested in. Capital has been quarantined, managed well. Yeah. So I think that's how I explain the difference there.
Yeah. And Hedley, do you think it's the big miners have still got their fingers burned from that last 2011, 2010 period where there's huge valuations, huge amounts paid for these takeover bids? Do you think that's creating a sort of more tepid M&A and perhaps a lack of spending on exploration, any sort of high risk development? Do you think that's sort of still
I think it definitely has put a bit of a reluctance on how things are paid for. Now, I mean, the ASX 200 Resources Index is the highest yielding, lowest price to equity ratio sector of ASX at the moment. So the market's not actually paying nearly as much for miners as it has in the past. And I think that's the first indicator that, miners aren't quite out of jail yet. They're still on parole. And with that in mind, when they're paying for acquisitions, they've got that very much at the back of their mind. So anything they buy has to be accretive either to earnings or to scale or to their strategic positioning within an industry. And I'd explain just about all of the deals which have taken place at the big end of M&A under those. So, in lithium, it's one thing. In gold, I think it's slightly different. And in copper, different again. But they've all got quite strong rationalisation for why they're paying what they're paying. And I think they're quite strategic. So, but certainly none of them have been paying for something which could be nothing.
I just remember being on the ground in Zambia in 2011 with Equinox, and that's when Barrick stepped in with their takeover bids. And the CEO, Craig Williams, I think he probably timed that sellout perfectly, because that was pretty much at copper's all-time high. I think at 7.5 billion takeover. So it was just if you ever look at the playbook of a smaller miner sort of setting themselves up for a takeover bid, I think that's probably the most perfect outcome.
Oh, absolutely, yeah, and I think you're absolutely right there, James. That was very well timed exit by Craig and the team there. And look, I mean, there's a person who understands market cyclicity very, very well, and had managed to raise money through a difficult period of time to finish that project off. So when all of a sudden gold companies decided they needed to be in copper for all sorts of funny reasons, they haven't really been rewarded for that. Gold companies that did that kind of thing. And it was definitely the best time to be selling Equinox. So, good on them. We've seen BHP just take over Oz Minerals, a big copper deal. And, people start to wonder about the drivers of that. There's a lot of discussion about, oh, well, BHP must want copper. I think that's definitely true. BHP does want more copper, and why wouldn't they? They produce it, they're making good margins on it, so why not expand your business? But Oz Minerals is their big neighbour in South Australia. They get 2 more mines which are producing copper concentrates, and at the moment sold into the global market. BHP has a smelter at Olympic Dam, and there's a huge contrast in the difference in concentrate specifications between what is produced by the Olympic Dam concentrators and the Oz Minerals concentrators. And if you put them together, you can make, I would say, some tremendous optimization decisions in your copper smelting business. So, buying their neighbour there, I think, was far, far more than just expanding. You could say they've almost got the extra copper for free. They've just optimized their business for a much longer future and a much better sustainable margin by doing so, and made themselves much more bulletproof in the process.
Absolutely. All right, Hedley, I'd love to stay and chat. I think we could keep chatting for a good while yet, but I think we better wrap it up. But just before we finish up, is there any sort of information? I think you gave us the ticker for Lion Selection Group. Is there sort of a website where listeners could find some more details?
Yeah, sure. So, and thanks for letting me give a plug, James. So check out lionselection.com.au. That's our website. The easiest position where you can start to look for some of the commentary which we put out, which might be of interest to some of your listeners, would be our quarterly reports. There's always a market review in there, and we report a month offset to the rest of the world. We have a July year end instead of June, so our quarterly comes out a month after the rest of the resource sector. So it's just come out, the April version. So check that one out, and that paraphrases a lot of the stuff which I talked about at the Gold Coast as well. And the ticker code LSX. So as Molly Meldrum used to say, do yourself a favour.
Alrighty, great, Hedley. It's good having you on. We'll chat again soon.
It's been a pleasure, James. Thank you very much for having me.
No problem.